Good morning, folks. This is Mayuresh Joshi at William O'Neill, India, and I hope you can hear. And I hope you can hear my audio and you can see both me and Radhika on your screen. So if you can give me a thumbs up or a hand, I think that should be good enough. So we can then start in the next 30 odd seconds. Super. Some few more people are joining in, so I just wait for 15-20 odd seconds, I think, and then we'll push off with this very enriching session with Radhika as well. Super. I think that's good enough responses that we got in. So I think the audio and video is absolutely clear. So great. Morning, guys. Welcome to one more round of Walk the Stock. Today we've got a very, very special guest, Radhika Gupta. You can see her on your screen. She is one of the youngest CEOs in the Indian mutual fund industries and one of the only women CEOs that we have at this point of time. Now, Radhika has gone through her own personal set of challenges, own professional set of challenges as well. She's done quite a few stints after pursuing her master's abroad, working with McKinsey, starting a financial firm, and now heading Edelweiss asset management firm as well. They're managing 65,000 crores in terms of AUM. And that's a huge, huge shout out and achievement, being one of the youngest CEOs and the only women CEO in the industry. So welcome, Radhika. Thank you so much for taking time out on a Saturday and sharing all your experiences that you will, both on a personal and a professional scale as well. So welcome to Walk the Stock.
Thank you. Good morning, everyone. Thanks, Mayuresh, and everyone for having me. And thanks so many people for tuning in on a Saturday morning.
Oh, absolutely. No. So I think the moment we put out Radhika, that Radhika is joining us, I think the kind of responses that we've got, I think are itself a testimony to the kind of popularity that you probably got in terms of sharing your views on social media platforms. And a lot of people, Radhika, want to hear your views as well. So before we talk about the markets, right, being the only women CEO in this mutual fund industry, and that you've scaled Edelweiss AMC to a totally new level over the last few months and quarters. How did you manage to have this transition? Because as I understood, it was more institution. You actually had a lot of retail foray inscribed into the funds. You want to talk a little bit about the journey on how you actually transformed the entire setup at Edelweiss and took it at a different scale altogether.
Oh, so I think it's been a really fascinating journey, and I joined Edelweiss Mutual Fund in 2017, early 17. And we had just acquired JP Morgan Mutual Fund then. I don't know if people remember, JP Morgan Mutual Fund had gone through some turmoil because of Amtech, and then we took over the team. I was actually running the merger process. I at that point had no mutual fund experience. So I was also quite finding my feet, and I was taking over a firm that was a merger of two very different companies actually, because JP Morgan Mutual Fund and Edelweiss, very, very culturally different entities. But it's interesting that well before I joined the mutual fund industry, I've been in India since 2009. Even in 2014-15, I was personally investing in mutual funds, and I wanted to run a mutual fund, and it was for the sole reason that I believed MF is a fantastic consumer product. I said, this is such a great product to invest in, then this would be a very good business to run. And that's how I think. I mean, I always think if something is good for the investor, then it's going to make great business sense. I mean, I think of that even when we look at companies. If you're doing something right for the investor, ultimately, and you know how to do the economics of it, it will turn out to be a great business. So, that's how I always wanted to do this. And, I got the opportunity back in 17. It's also interesting. I think in 2017, we were a very, very small entity trying to find our feet. I mean, I think pre-merger, we were ranked 36. When I took over post-merger, ranked 26 or 27, very, very small entity. And back then, I think there was a lot of resistance to the idea of new entrants in mutual funds. That incidentally has changed today. I mean, there are probably 10, 15 new people, from Zerodha to NJ to Navi to anybody. I mean, there are probably going to be 60 mutual funds in the country today. So I always say now it's like the guys are making Star Kid like debuts. We were making debuts like, the Juhi Chawla and Madhuri Dixit of that time in some unknown film, and nobody really cared because, you were told that this was an industry that was consolidating. Big players had all the distribution. So firstly, I'm very happy to see the change in the industry over the last 4 or 5 years. I think what we have tried to do over the last 3, 4 years is a few things. One is to find product spaces that we can be distinct and win in. It's very difficult to start a new mutual fund and say, I'm going to be the 45th guy to sell you a meaningful large cap fund. I mean, it's highly unlikely that someone is going to buy that story. And so we took a category like balanced advantage, where everyone was running a fund in one particular approach, and decided to run something in a very different approach and market it with a lot of conviction. So we were not afraid to be different, and that scaled to be one of our largest funds. When the whole opportunity came around fixed income, and there was a big thing that how does a small AMC find scale in fixed income? Because every time you go to raise a fixed income fund in this country, people say you should have size, but how do I get size? I mean, it's a chicken and egg problem. And so when the Bharat Bond opportunity came, and we can talk about that later, we said this is a great chance to think about fixed income from a fresh perspective. When global investing, nobody was doing, we were talking about China funds back in 17. Now, of course, China doesn't sound so exotic. People are doing EV funds and semiconductor funds and really Taiwan funds, and much more exotic stuff is happening. So we tried to find niches and build. And I think the other thing is, most people don't know this, our team is extremely young. So we've been hiring people who are a little unconventional from the industry lot. They're from industry, but they're much younger, so they're all 10, 15 odd years. They're in first time leadership positions. So there is a sense of jazba. It is very much a startup culture that we want to do something. We are here. If you ask them why you're there, most of them say they're there to build a legacy. It can't just be for money, etc., etc. And I think that's a very powerful spirit. And, of course, the world and life has been kind. The distributors are kind. I mean, we're currently sitting on 78,000 crores of assets. So we couldn't have asked for more. And yet we still think it's early days.
Wow, that's really inspiring, Radhika. In fact, it takes me back after you were graduating and your story thereof. I think a lot of people might be not aware of this, but you had categorically mentioned this. You'd gone through 7 rounds where you probably thought your 7th interview, you cracked that. And then the McKinsey interview, which happened where you discussed bridge, right? With the interviewer as well. And she categorically said to you that we hired you because you're different and you're unique. And that's the strategy that I think you're adopting in Edelweiss as well, right? The differentiated strategy. But when it comes to an investment perspective from a mutual fund, being a mutual fund player, right? Is the investment strategy differentiated as well? I think, is the thought process different than the normal course that you got? How is that stacked up at this point?
Actually, yes and no. I think, investing is not complicated. Investing is about doing simple things and doing them right. Now, I think one of the things that is perhaps less appreciated in the investment field is that there is no one right approach to investing. And let me give you an example. When we run a fund that chooses to allocate between debt and equity, this is a very simple decision that most balanced advantage funds, and that's a popular category, so I'm going to pick that up, make. Now, how much to allocate to debt and how much to allocate to equity is a decision that you have to take, and there are many ways you can take that decision. A very common approach to taking that decision is buy low, sell high, which is what we call price to earnings based. And we've all been fed on that diet of buy low, sell high, and Warren Buffett, and it sounds very right. And there is nothing wrong with that approach. We chose to take a slightly different approach, which was called a momentum-based approach. So our approach was that if you're driving from Bombay to Pune and the road is very clear and there's a nice highway and the weather is fantastic, then you will pick up speed. And if the weather is bad and the road is bad, then you will cut down speed. Globally, this approach is called momentum. In another analogy, I think if you had to do selection for the cricket team, one approach would be I would pick an out of form player because he's going to bounce back, and that is value. And one approach would be I would pick the guy who's the current favorite because he's been performing, and that's momentum. And the reason I'm making this point is within investments, there are multiple different approaches to doing everything. And there's no one right or wrong. What is important, though, however, is to have conviction. So the worst thing you can do is change approaches constantly. I think it's very important to find an approach and stick to it. And so that's what we've done. I gave you an example of balance. We have a belief that when you run a mid-cap fund, for instance, you will not hold a single large cap holding because that's just not the mandate. This causes us trouble because there are times when markets fall and a lot of our peers will hold large caps, etc. And our fund will fall more. But there is a consistency. And I've often seen in the investment profession, finally, people don't buy performance. They buy the conviction of the person who's managing your money. And that's how we built the business. So I think whatever investment approach you follow, if you follow it consistently, people will buy your conviction. And that's what I've seen.
Oh, absolutely, Radhika. In fact, we at William O'Neill, not just in India or US, right? Our founder itself is one of the fathers of growth investing. So I think absolutely understanding what you're saying, right? So the approaches are different, folks. And the pertinent point Radhika is putting is it's no single fit for a particular market. You have to determine.
I would add one more point here is that from an investor point of view, I think we spend a lot of time looking at numbers and returns. It is very important to understand the investment approach that any strategy, AMC, or anyone you're dealing with is putting out. And the good news is, by the way, a lot more asset managers are becoming communicative about that. So if you go to our website, and there's also peers, right? Every fund, there is a detailed document with how these funds run. And once you understand the approach, you will understand when that approach does well, when that approach doesn't do well. So for you also as an investor, your expectations will be well set. That's one. Secondly, when you build a portfolio, as much as I would like you to only own Edelweiss, that's not going to happen. You can actually build a diversified portfolio of investment approaches. Once a diversified portfolio is not one that holds 15 mutual fund schemes that are all doing the same thing. It's one that really captures different approaches to investing that perform in different market cycles. Once you understand investment philosophy and approach, you will be able to build a better portfolio and you will be able to set your expectations better.
Well, absolutely, Radhika. And it brings me to my next question, right? The notion is that if I own 10 or 12 mutual funds, right, I am well diversified. And if I have a fixed amount put in, through SIPs, I think I've done my part in terms of my financial planning. Mm-hmm. Does it really work? Do you think the downside risk in terms of number of funds or having the appropriate funds and an appropriate value subscribed to each fund depending on your risk reward? Do you want to just stress on those 2 points?
Sure. So I think one, in terms of number of funds, I'll make some points, and then I'll make some points on asset allocation. Sure. Number of funds in themselves is not diversification. For instance, holding 10 value funds is not diversification. Holding, by the way, AMCs also have generally, while you can have different investment styles within the same AMCs, I will be honest enough to say there's a lot of overlap. So if you're holding 10 funds of Edelweiss, chances are, unless if you're holding 10 long only equity funds of Edelweiss, chances are there's a diversification problem there. But also, by the way, I've seen portfolios that hold 80 and 90 funds. That's just a terrible job at diversification. And more of it is happening now with all the NFOs coming to market. You just feel like, oh, there's one exotic idea. Let me buy this. So, that builds for really bad portfolios. I think a good portfolio is built using a couple of things. One, it, I think, has a clear notion of what is core and what is satellite. So I always tell investors that have this concept of 80% of my portfolio is very basic and dal chawal like. It has the basic equity, fixed income, etc., and how you want to allocate that. And then 20% is all this tactical stuff. Otherwise, and I am part of the mutual fund industry, you will not be able to make sense of the thousands of schemes that we have to offer. It's just impossible for anyone to do. So I think that is extremely important. I think within the core portfolio, what matters is very sharp sense of asset allocation. So basis your risk appetite, the kind of equity allocation and the kind of debt allocation, and making sure you're comfortable with it is actually the most important thing. Fund selection actually matters far less. Ultimately, whether you hold, and this is contrary to my profession because my job is selling my funds. Ultimately, whether you hold XAMC fund or YAMC fund matters a little less, and getting that asset allocation right matters far more. So because I've seen, investing is ultimately about lasting, right? And if you get the risk appetite wrong, and you're not able to tide through March 2020, and you are the guy who redeems in April, or whatever it is, and I know many such people who have done that, it doesn't matter what fund you hold, it's also about lasting. So I think asset allocation gives you that lasting ability. And I would reiterate the point I made around core satellite, because at least when you keep 80% of what you want to basic and simple, you build something that is genuinely robust.
Oh, very candid, Radhika, and point absolutely taken. But just to drill down a little bit more on this aspect, say a retail guy, right? He wants to put in an X amount of money. What would be your ideal setup, right? I mean, 2 long-only equities, 1 diversified, 1 bond. How should that be placed?
Sure. So I think for the average investor, there are two ways to cut this cookie. For your core portfolio, I think some large cap allocation, some mid cap allocation, and some fixed income allocation that is, and I'm not talking about liquid money and cash management that you keep separately, but some fixed income allocation in the 3 to 5 year bucket. I think that is really the core. So, and there are multiple ways. So this is what you want to accomplish, and you want to accomplish it in a ratio. Now, instead of the large and mid cap allocation, you can change it to a flexi cap allocation and a fixed income allocation. What I personally like to do is take away all of this and move it to one single balanced advantage fund that does all my rebalancing for me, because it's just tax efficient. So this is the cookie that you have to accomplish. Now, how you create it, there are different tools that you can do, but this is effectively what it is. And I think this can be accomplished in 4 to 6 funds, actually, very, very cleanly. A maximum of 8 funds should be able to accomplish this for you. Everything else then can be satellite. So then your satellite allocation, for instance, if your core allocation is a balanced advantage fund, which is mine, your satellite can be mid and small cap SIPs and some international equity SIPs. So then that's a very clean asset allocation. Or if your core allocation is fixed income and flexi cap, then maybe your satellite can have some international. And if you want to supplement it with risk, you can add some small cap or thematic allocation. But that's how I would think about it.
Absolutely. And again, I think we'll talk a little bit later in terms of the IPO and the Bharat Bond that you got. But that's for later. I think now we'll come to the focus in terms of how the market setup is, because a lot of people are interested in your views on the same as well. Sure. Have you seen suddenly, I think, markets getting that risk factor in terms of liquidity being withdrawn, inflationary risk, COVID cases rising around the globe, supply chain issues, so on and so forth. So basically, I think just as an overview, how do you see the market setup right now? Do you think this is a correction within a longer structural bull market? Or is there something structurally wrong with the markets right now?
So one, I would say I don't think there's anything structurally wrong. I do think for investors, however, the last 18 months have made expectations a little odd, because what you have really seen is a straight runaway bull market. And I think in some names, and we'll get to this, a reasonable amount of froth. So sometimes it's hard to comprehend. So much so that when I talk to investors these days about fixed income allocation, they tell me I make 6% in equity in a month, I'll make that in fixed income in a year. I think, and what has happened is that over the last 4-5 odd weeks, 3 months, a little bit of correction is making you ask these questions. And it's especially difficult because this market rally has also seen the rise of the individual investor like we've never seen before. We were an FII dominated market, then DIIs, people like us, mutual funds showed up. And now you've got this individual investor, Robin Hood, whatever, millennial, call it whoever you want, that people also don't really have a handle on. And it's becoming a more powerful force. And it's also a younger investor who's, as I said, a child of a bull market, who's never seen a correction. So it's a little tricky, and one doesn't know how this investor is going to behave in a correction. I think in terms of risk. So my short point first is that a 10 to 15% equity correction is normal par for the course. It is just par for the course. And I think in terms of emerging risk, there is always a category of emerging risk. Now, Omicron obviously has been in the news. I would only make 2 points about the virus. I think the risk of a virus has always existed. The only problem I would say is that one, it is very hard to make a scientific assessment of the current strain. The more important thing is that even if you were to make an accurate impact of the health impact, and you remember COVID wave 2, it was devastating for India. It was really, really bad. I mean, all of us have stories. It was not devastating for the markets. So it is hard to, going into wave 3 or 4 or 5 or whatever you want to say, predict not just Omicron, but whether it will lead to lockdowns and whether that will have an impact on the market. So that's the first thing I would say. And I think the impact on the markets of these things is actually becoming a little less severe than we think. Inflation and rates rising, I think this is a more meaningful matter. And if it starts to show in company results, which we're seeing some signs of in the last quarter earnings, then I think that is something meaningful to worry about. But if it comes back with growth, then perhaps less. One thing I can tell you though is that what gives us optimism is earnings give us optimism, because I think India is coming off a 10-year earnings low. And I think Rashesh at Edelweiss calls this, he uses this word, the animal spirits of the Indian entrepreneur. If you talk to promoters across sectors, you're hearing capacity expansion, trouble hiring. So you are seeing the private sector animal instincts come back, Capex coming back. So I think that gives us a lot of optimism about the fact that in the long run, we are in a meaningfully, structurally exciting place.
Wow, nice to hear that, Radhika. In fact, interesting, I was going through some data points last night, Radhika, and I'm sure you're pretty much aware of that as well. In the massive bull run that we had from 2004 and 8, right? We did have these corrections of 20-25%. And in that same phase, the Fed had actually hiked rates 12 or 14 odd times. And still we had this multi-year bull run which continued. So point absolutely taken, Radhika, that you're trying to put.
And that was a period. If you ask why the multi-year bull run happened, that was a period even in India where you saw earnings growth year on year being meaningful. So I think ultimately you're not the market is a collection of individual companies, and individual companies are a collection of profit-making entities. And if earnings are growing meaningfully, it will finally translate into markets.
Oh, absolutely. Point taken, point taken. So within the set themes, right, that Edelweiss is looking at this point of time, are you looking at certain sectors in the correction that we are seeing, certain sectors that are appealing to you at this point of time?
So I think from our point of view, one is we are a big advocate of diversified funds in general. And I think there is a lot of noise that is made around individual sectors. Our belief is that the last 1.5 years saw fair elements of sector rotation. I think the emphasis on individual sectors will give way to more stock specific action. So from our fund management focus, we are actually less focused on taking sharp sector bets and more within those sectors looking at market leaders. That said, we do think the Capex side of the economy, whether it is sectors like industrials, electronic manufacturing, which could be aided by China plus one. I think some of those sectors, look interesting to us. But individually, I think, we are much more sharply focused on stock picking, because we think with where markets have come, the whole sector outperformance, I think there's less delta left there.
Absolutely. Unfortunately, we can't talk about stocks. So let me put it the other way around. And let me play the devil's advocate here, Radhika. On China plus one, right? That's a theme that has a common underlying across funds, across retail investors, across channels that we see, right? Where do you see the risk factors? Do you see that supply chain issues not being completely backward integrated even now can pose risks and challenges to the China plus one story? And if so, I think what are the perceivable risks that you need to observe or monitor in this entire China plus one themes that you're looking at, whether it's textile or specialty chemical?
So, firstly, I would say that, I think India is not going to be the only beneficiary of China plus one. I think one of the challenges with the China plus one narrative is that the assumption is that everything is going to come to India. And I think if you see economies like Vietnam and Bangladesh, they're doing a fantastic job as far as, China plus one is concerned. I do think, however, in specific segments, China plus one, bolstered by the fact that you also have strong local incentives to do things from PLI think may be a positive. So, for us in our portfolios, China plus one can't be a predominant theme. It can be a catalyst to what is already happening in India, but can it be are we going out there and launching a China plus one or manufacturing in India fund? I think it's a little premature to say that.
Fair enough, Radhika. Now, the IT sector has been in focus, specifically after Accenture upgraded its growth estimates and its earnings estimates as well. So if I have to pick and choose, right, momentum and somewhere where there is value, right, where does IT sector fit? Does it fit in momentum? Because the stocks are clearly on a different growth trajectory. Valuations, specifically mid-cap IT, are way ahead of its large-cap peers as well. Do you think there is still some juice left in this sector, or are you looking at some beaten down names within the auto pack? So we got your Capex team absolutely fine. Within auto, I think the EV story is playing out because there is some element of certain stocks doing well. But the core autos, I think they're underperforming at this point of time. So I think is it a momentum bet with IT, or is it a value bet in one of the facts with auto?
So by the way, I actually think, and there's this question on, and I know that someone mentioned, by the way, that my Edelweiss background is showing up weirdly. So let me fix that. Thanks for mentioning that. So I think, by the way, there's an interesting statistic I must tell you on IT. I think India's IT exports this year are going to be more than Saudi Arabia's oil exports this year.
Wow. Okay.
It's a staggering statistic. I read this somewhere yesterday. And by some mile. So it's a staggering statistic, and I think Indian IT is really in that sense coming of age. In fact, I think it is now hard to compete with the Indian IT sector in terms of scale, size, and experience. And I think that's how it's going to be. So I don't want to categorize this as a value or momentum story. I've always, by the way, believed that value is, ultimately they are sides of the same coin. But I think Indian IT has come of age as an industry, and I think I still see a lot of optimism. I mean, we are very optimistic because I think it's a sector that is coming into market leadership, and I think globally it will be very hard to compete with Indian IT.
Breath, what about auto? Because they are going through their set of challenges in the transition phase to EVs, the R&Ds that is required. So I think is that a value bet, or is it a value trap at this point of time?
So I don't think auto is a trap. I think auto has had its own challenges post COVID. EV is something that I think is inevitable to come to India. We have been, say, tentative on seeing how and by the way, I know there are a lot of EV funds. I was shocked. I saw 4 or 5 electronic vehicle MF filings coming out. We've been a little tentative, in terms of, there are lots of EV players coming out. There's some very exciting stuff happening in that space. But it hasn't made a material impact even in some of our larger global markets. So until that starts to happen in India as infrastructurally levy, we've been just doing a wait and watch here.
Fair enough. So Radhika, I think on the Capex theme that you're talking about in India, right? We've normally seen this, that as demand comes back and utilization levels start moving higher, a lot more projects start coming in, and they probably continue for 2 years and they start tapering off. So in your opinion, as you pointed out in your remarks as well, I think you think that the phase is right in favor for these guys at this point of time.
I do. And as I said, when you're having conversations with promoters, I think their investment in capacity, there's an interest in increasing capacity. There's an interest in sort of projects are picking up across the board. And the fact is that nothing has happened for 2 years. So I think we are very optimistic. And for the last 2-3 years, I think growth and markets have really been led by the consumption side of the economy. And I think it's now way forward. And you have a lot of incentives that are sort of supporting capex. So if we don't have material lockdowns, I mean, unless something really goes out of whack, I think we think it's a time for capex to pick up. I mean, India should be at the beginning of a meaningful capex cycle.
Absolutely. So an offshoot to that, real estate, suddenly I think demand coming back strongly, and the ancillary plays, home improvement. I think you think there is reasonable scope out there as well.
So we are optimistic about residential real estate. I think commercial, the word it is still
Okay.
what has happened is in the last 2 years, one, not too many new projects have been created. There have been incentives in terms of lower stamp duty in states like Maharashtra, etc. COVID, I think, has spurred a lot of people to re-look at home buying. I personally redid my home buying, and a lot of people, I mean, builders are telling us that, where people could afford a 2 BHK, they're stretching to a two and a half, three. So there has been a consumer sentiment increase in sort of upgrading homes. And because there hasn't been supply, I think the good builders are doing exceptionally well. So it's a shift from everyone to the guys who are good in the space. Plus, with equity markets where they are, and interest rates being low, I think home affordability is also extremely high. And so I think you will see some revival, especially for the good set of builders. Commercial real estate, I think one will have to wait and see how hybrid models, work from home. We halved our own office capacity, and I think there are many people who are looking at some kind of permanent work from home. So commercial will have to wait, but I think the residential buzz has definitely picked up.
Absolutely. And what about the proxy plays, Radhika? The home improvement players when real
And I
estate?
think that is all linked because ultimately, if people are going and building out more homes, then home building tools, everything is linked. So I think the whole story around residential real estate is going to be a very, very powerful one.
Absolutely, absolutely. And the backdrop and the backbone for all this is the guys who give loans, right? So financial services, NBFC. How do you view them?
Again, I think NBFCs, and I come from an NBFC, also have come out of a difficult credit cycle. But we do see credit growth picking up across the board, especially retail credit growth. And so, again, I think it has been an opportunity for good NBFCs to come back. I think, in fact, if you look at Nifty results, one of the strongest drivers of Nifty results has been the financial sector.
The order of preference here within financials, I think, is it the larger private guys shunning the public sectors at this point, or do you see absolute value coming back to the public sector banking space as well?
Not yet. I think public sector, with the exception of a name here or there, I think private sector banks, without taking names, and also new age financial services companies. I think one thing that people have ignored is that there are a lot of new age financial services, fee earning models now. Your exchanges, your depositories, your asset management companies, all the fee earning part, or your insurance companies, all the fee earning financial services, brokerages, all of that. So I think the two places are banks and your new age fee earning financial services.
Absolutely. So reading between the lines, Radhika, on what you're pointing out. The other aspect is the classical defensives, right? And you briefly touched base on that, where you categorically mentioned that during lockdown, I think the consumption theme or the discretionary spending theme did well.
Yeah.
Do you think that the theme has run out of steam? Valuations are a little bit on the higher side, or are there structural issues when markets reopen and capex themes come back? These industries start falling back in terms of investor preference.
I think the one thing you have to watch out for in these industries, and being brief in the interest of time, is the impact of inflation in some of these traditional segments. We are actually starting to see that in quarter four results. One theme that we are definitely looking at is the longer term shift from traditional FMC consumption to more discretionary consumption. I think as India makes that journey towards a $5 trillion economy, and you've seen this in markets like China, discretionary consumption, your lifestyle, your health, your diagnostics, etc., that +1 consumption. I think that is a much more meaningful thing. I mean, ultimately, there's only so much toothpaste that you can buy, but there's a certain amount of spending that you will do in improving your lifestyle, apparel, all of that that comes into the play.
Absolutely. Now let's get your views in terms of the two aspects that I briefly mentioned: the IPO fund and the Bharat Bond ETF. IPOs on a hot streak, Radhika. So, what is this fund, and what are the distinguishing characteristics that you probably need to mention here?
So I don't think there's ever been as much buzz about the IPO market as there, has been. And by the way, I mean, even before I talk about the fund, I don't think the IPO opportunity is going away in India anytime soon, because so much money and capital has come to India via the private markets in the last decade that it will need to find an exit, and that only reasonable exit is going to be the IPO market. Now, the reason we had created this fund 4 or 5 years ago as a closed-ended fund, and then on investor, and it had done reasonably well. So we opened up the fund this year. It's called Edelweiss recently listed IPO fund. It's the only one in the category. We created it to address a consumer problem that people have with IPOs, and that, by the way, over the last month or two has become a lot more heightened. Part one of the problem is nobody gets allotment in IPOs. And if I ask people to put up emojis on their allotment problems, chances are you'll get lots of them. Secondly, as I think investors are struggling with which IPOs to invest in, and that is only getting more complicated as business models are getting trickier, loss-making companies are coming to market, DRHPs are becoming 500 pages. I mean, it is a difficult thing to do. It's a difficult thing to do as a fund manager. And the third is people look at IPOs as a listing day gain and disappear play, not realizing that IPO is just an event in the life of the company. It's not, I mean, a good company is a good company, and you have to hold it beyond the IPO, because once it hits the listed market, it becomes eligible for investment by a new set of investors who can take it to the next level. So we created this fund where a fund manager is applying and selecting and participating in IPOs with a professional judgment, not just on listing, but even if the company falls, I mean, there may be a company that's very expensive on listing, but may fall 20% after listing, and maybe a perfectly valid company. But essentially a fund that could let you participate in the new economy companies. I mean, one of the great things about the IPO market is it reflects the new economy companies. I spoke about financials, right? Old economy banks, new economy, new age financial services, old economy IT services, new economy gaming, e-commerce, etc., etc. So I think that is the play to look at a new economy, and it's been one of our most popular offerings over the last year, understandably. But the idea was to bring professional management to solve this problem for consumers.
So this is now open-ended, if I'm getting it right.
It's now an open-ended fund. It's out there for retail investors to look at. And it typically has a basket of 30 to 40 companies that are recently listed over the last couple of years. It can participate in the anchor investor route. It can participate in the normal IPO course, and it can participate post-listing. And many times, by the way, it ignores companies on listing and does it after. Interesting fact is this year, probably 50-55 IPOs have come. I don't think this fund has done more than 20 IPOs. So that's how selective we've been. So there's been a lot of avoiding this year.
That was what I was coming through, I think. How do you pick and choose between that?
Yeah, so I think picking and choosing is tough. We try to look at business models that are structural, and most of our weight is assigned to structural business models. We spend a lot of time, because the good thing about IPOs is you get time, right? 3-4 months, doing research, meeting promoters, having those conversations. We also have run pre-IPO funds in the past. So as an ecosystem, we've also tracked these companies well before they come to the IPO market. So we are looking at business model, we are looking at margins, we are looking at leadership, we are looking at forensics and business quality. And that's how we make a decision. And as I said, we classify businesses into more structural businesses, cyclical businesses, and more secular businesses. And our focus remains on more secular businesses with smaller weights to more cyclical businesses.
Yeah, so that's great to hear that, Radhika, because a lot of people don't, as you said, it's just a dream of getting an IPO. So I think the IPO fund guys is out there from Edelweiss, can have a look at the performance on their site, so on and so forth. Let me come to the other part of the ETF, right? The Bharat Bond ETF. Now, a lot of investors probably feel a little bit skeptical, who are pure equity investors, right? How do you allay their fears in terms of what a Bharat Bond ETF has to offer, both in terms of a return and a risk perspective, and even a tax perspective?
Sure. So I answer lots of questions on. Give me one sec. I have to charge this laptop before it
Sure.
dies. So give me half a second. This
Not a
happens.
problem. Not a problem.
The reality of life of doing events on Teams and Zoom. So Bharat Bond ETF, I think firstly, I would say the purpose of Bharat Bond ETF was to give investors a very simple debt tool that they could trust. And this is a passion project. I mean, I've spent a year working with government to develop what finally became Bharat Bond ETF. I think if you go to the problems in fixed income, there are a couple of problems that investors have with fixed income. One is the whole element of credit risk. And that is allayed in Bharat Bond because it's AAA PSU. It's your highest rated companies owned and managed by Government of India. So I think that issue goes away. The second problem, which is less talked about, which is a real problem, is कि मिलेगा कितना? When you invest in a debt fund, investors are always confused. Oh, interest rates are going to go up. Interest rates are going to go down. What will the return I earn be? Bharat Bond solves that problem. It packages these products like FD. So it's got a structure that's globally called a target maturity structure. And you see Bharat Bond 23, 25, 27, whatever. Basically, these are products maturing in a certain year and they're buy and hold products. So if you buy Bharat Bond 2025, you're buying a portfolio of AAA PSU bonds that mature in 2025. We give you an indicative yield upfront. And if you just buy and hold Bharat Bond 2025 till then, you will get that indicative yield regardless of what happens to inflation, whether RBI moves interest rates up, down. There is a high element of predictability of return that people enjoyed with FD. So that is what is on offer. A predictable return in quality instruments. And on taxation, I think FD investors, I would like to tell you that today, if you do a bank FD, you're earning 5.5% pre-tax and less than 4% post-tax after marginal tax. Bharat Bond enjoys indexation, so 20% minus the prevailing rate of inflation, which means a 6.5% Bharat Bond, which is one of our recent launches, will be about 6% post-tax. For an equivalent tenure, the delta over FDs can be between 1 and 2% post-tax. That's a very, very meaningful outcome. And I think that's one of the reasons the program has become so popular. I mean, it's a 40,000 crore business in the last 2 years. So, and this has not been an easy 2 years for the debt mutual fund industry. So for investors, and the way to use Bharat Bond in your portfolio is if you have 100 rupees, break it to invest in fixed income, break it into money you need in 3 years, 5 years, 7 years, and then match your needs with the tenure of the Bharat Bond available, because now you have 5 products out there.
Makes sense and very meaningful. And you actually answered the next question, because I was going to ask you a portfolio allocation on that front as well. But it does make sense. So I think a Bharat Bond ETF being part of your portfolio makes absolute sense, right, Radhika? For anybody's portfolio.
I think for a debt investor, this is the cleanest and simplest debt product out there. And now, and by the way, they're not just Bharat Bonds out there. After Bharat Bond, a whole spate of passive debt index funds, including ones we run that do PSU, SDL PSU, like we run a 26 and 27 series. So at Edelweiss Mutual Fund itself, you now have 7 products between 2023 and 2032 that you can pick to build a debt portfolio. I mean, and it's all at virtually nominal cost. So I think there's never been a better time to be a debt investor with the range of things out there.
Yeah, valid point, absolutely taken. Now let's shift to a totally different aspect in terms of the mental mental state of approaching markets, right? And then you can just briefly touch based on how you have practiced this professionally as well. You must be getting a lot of queries as well. All-time highs, correction, and we discussed that whether it's structural or not. But people do get jittery, and if the markets do fall further and they see their value eroding in terms of absolute percentage returns, I think that apprehension starts coming out. So, how do you mentally position yourself? Is it a part and parcel of the longer term story that we are running through and that you should take it in your stride? What should be your mental approach in markets when they are falling specific?
I think that there's two parts. There's before and after, right? Before investing, I would repeat the point I made on asset allocation. I think if you have allocated correctly, a correction should not cause pain. And by the way, whenever this correction ends and things come back to normal, this is a good, because nobody understands their risk appetite in a bull market, right? We all have risk appetite in a bull market. You understand it in a bear market. You should go back and ask yourself that difficult question. Was I really stressed when the market fell 10%? Okay, maybe I had too much equity allocation out there. So I think one is we ask a lot of questions after investing. We need to ask ourselves tougher questions before investing. And we need to ask them after we've experienced even the smallest bear market. So that's point one. Point two is I think we need to spend less time looking at the news. We live in a world where your mutual fund NAV falls once a day. The news makes it feel like it falls 10 times a day because you get Twitter alerts, you get WhatsApp alerts, you get family groups, you get friends groups, you get money control sending you messages, your phone alerts. It is complicated, and it just forces you to take a decision. I think the best thing so I look at my portfolio once a quarter. I actually didn't look at it in March 2020 because it wasn't my quarterly review. And I highly encourage, and when I did a Twitter poll recently, how often people do portfolio reviews, I was hoping the maximum would be monthly. It's actually become daily for a lot of people. And what I would tell you is that that is unhealthy, because ultimately you're not investing in mutual funds or stocks. You are buying shares of businesses. I mean, it is a share of a business. And as a head of a business, and everybody here works for a certain business, I can tell you businesses don't move every day. There's no way they move every day. Business prices may move every day, but business realities don't move every day. And I think you have to anchor yourselves down to that very basic fact that if I'm buying shares of Hindustan Unilever or Reliance, the business prospects of Reliance don't move every day. I mean, it's just not possible, right? So reading less and having less alerts is actually a very. I was talking to Sanjay Bakshi, who's the famed value investing professor, and he's actually got his app on his laptop where he just disables alerts. And I think it is a very powerful thing to have. So just hearing less noise, I think, is extremely powerful. And the third thing I would say is, you have to ask. I always encourage more investors to ask tougher questions of asset managers and financial institutions. When you're investing in a fund, the easiest reason to invest is because 5 people told you about it. Ask the difficult questions before investing. That really helps.
Oh, absolutely. In fact, this is a very important point you've mentioned, Radhika. I think ask the difficult questions, and before investing, ask those couple of tough questions to yourself. That what happens if what situation should get ready. A couple of user queries that we've got, Radhika. One user is asking some insights that you can give on the insurance sector with obviously COVID in sight, right?
Okay, so I generally, and I also represent a business that runs 2 insurance companies. I'm optimistic, particularly about the general insurance sector. I think people are placing an increasing premium on things like health insurance. A lot of people have gone back and revisited the fact that they need significantly higher health cover in this period. And I think good insurance companies, and there are some very good digital models that are emerging, particularly in the general insurance sector. So I think traditionally an industry that was a very capital balance sheet heavy industry is also learning to become a digital driven industry. So I'm actually very optimistic, particularly about the general insurance business.
Great to hear that. But do the concerns in terms of higher claims for the insurance, specifically the life insurance sector, worry you, or is it just a transitory phase at this point?
I think it is a transitory phase. I think life insurance is still finding, has its own set of challenges. I think my optimism remains largely general insurance focused.
Okay. Got that point very clearly. Now, before we end the conversation, Radhika, I think a bit about your personal story as well. I think it's been a story which was challenging since growing up, and I've read a lot about it. I've heard a lot about it. I think for folks out here who have not heard about it, I think there's a very famous speech that you had given, right? The girl with the broken neck, and how you managed to overcome all those physical things, and also that instance of that interview instance that I just mentioned, where you were planning to take an extreme step and suddenly happened. So I think that personal story of yours, I think it will be a motivational aspect for a lot of viewers out here. And it is emotional.
So, yeah. No, so I would encourage everyone to definitely look at the talk, because I probably won't do justice to it in
Yes.
2 minutes. But I think I get till date, I get questions from all over India about the talk. But I think one of the themes that I've spoken about, which is very close to my heart, is that one, none of us is perfect out there, sitting on any screen. Just like there was an issue with my background, there are issues all of us have in terms of how we look, baggage we carry in the past, imperfection, and that's just the way it is. And second is, everyone goes through their own challenges as far as rejection, etc., is concerned. And unfortunately, our system doesn't teach you. Your system tells you work hard, get into a good college, do all of this. But what if after doing that, it just doesn't happen? So I think rejection is part and parcel of life. And my only point is, don't wear these things as a badge of shame. This happens to everyone, and I've learned from doing this video, because I get hundreds of messages, that everyone has a story of struggle, everyone has a story of embarrassment out there. Don't let it weigh you down, because you limit your potential when you let this kind of stuff weigh you down.
So folks, I think just have a look at the video. I think it's really inspirational, and the way Radhika has put forth. I think it's a 17-18-minute video. Right?
Yeah, it's a 17-minute video.
Yeah, so it's you can search it on YouTube, and if you don't get motivated by that, I think nothing will. So Radhika, I think it is really a great pleasure of having you for the last hour here. Your insights, your thoughts, your entire journey itself, I think real inspiration and motivation, at least for me, and I hope for all the folks who would see the video and hear you out as well. So thank you for sharing your views with us. Thank you for sparing time for us, and hope your stint with Edelweiss grows. You grow as the CEO and MD. Your fund grows to greater heights. All the best to you and your team. Be safe, and all you folks as well. I think be safe, and thank you so much for joining us. Thanks.
Thank you, everyone. Be safe. Happy weekend.
Thanks for that.